Let's take a look at what variance analysis is all about. The variance itself is just measuring the actual difference between results and the budget. That's all the variance is. What is the difference between the volume of production to be budgeted and the volume of production that we actually achieved? And then there's variance analysis. This is where we take the variance numbers and analyze them and try to make takeaways about what happened. So, for example, explaining why we missed the budget. What was the reason behind the production shortfall? We budgeted 100 units to be produced, only 90 were produced. What was the problem? Was it an issue with the manufacturing process, labor shortage, or was it just a strategic decision to move away from the budget during the actual month or quarter or year? So this is what we're going to dig into in the coming sections. Let's take a look at calculating variances with a simple example. So on the left side here, we've got our typical income statement type items where we have volume, revenue value, variable cost, fixed cost, and then your profit. So here's what we budgeted. 100 units to be sold, that's $1,000 of revenue, $500 of variable cost, 200 fixed, leaves 300 of profit. Alright, perfect simple example. Now let's look at some variance with those numbers. So, the same budget is thrown up here on the screen, and then we're going to compare it to the actual results. So only 90 units were sold versus 100 that were forecasted to be sold. The value was $990 versus $1,000, variable costs $495 versus $500, fixed costs were higher than expected, $210 versus $200, and therefore the profit was lower than expected, $285 actual versus $300 budget. So here's an example of just simply laying out the variances that were experienced. We haven't done any analysis to say why this has happened or what it means, but we've done step one, which is we've identified the variances from the budget to the actual results. Let's start our variance analysis by looking at volume and price. These are the two main drivers of revenue and the most likely causes for the miss on revenue. Alright, so let's look at flexing the budget, the sales volume. So what you can see here is an original budget with 100 units of volume for sale, a revised budget of 90, and the actual numbers that came in of 90. So what you can see here in this variance analysis is that the sales revenue number that was different than the budget was not because of a volume change. The revised budget and the actual numbers are the same in volume. But let's go now and look at the price. So what we can see is the difference in revenue obviously came from price because the number of units sold were exactly the same. This is an important distinction to make when looking at revenue variances. Always attribute what percentage of the change was due to volume and what percentage of the change was due to cost. Then further investigation can be made as to the underlying drivers of those changes. Let's look at an example of variable cost variance analysis. So what we're going to do here is bring up these numbers again, and you can see we've got an original budget with variable costs of $500, a revised budget with variable costs of $450, and then actual results where the variable cost was $495. So in this case, we're measuring the variance relative to the revised budget. Depending on your organization and what you think makes the most sense, you'll compare it to either the original budget or the revised budget, or perhaps even to a forecast as well. Revised budget typically is the standard, so we've got this $45 variance of the actual versus the revised budget. Now what we need to do is break that down further and understand where the miss came from. So, in the original variable cost budget, here are some assumptions that got us to that $500 number. We assumed we would need 2.5 meters of material for every unit, and the price of that material would be $2 per meter. So then you can see the multiplication of those numbers gives us 500. The actual result that came in was that 2.0 meters of material were used for each unit, and the price was $2.75 a meter. We sold 90 units, so when we multiply all of those together, we get $4.95. Let's compare that to the revised budget, or the flexed budget, where we had 90 units at 2.5 meters at $2 a meter is $4.50. So we've got this variance to further investigate. What caused that $45 difference? So you can see that we've got two offsetting forces here. We've got something that caused us to be worse than budget and something that caused us to be better than budget. The net effect was $45. So let's take a look at the components. On the price side, we had budgeted $2 a meter, but we actually paid $2.75 a meter. So that difference, that 75 cents per meter, multiplied out by the total number of meters purchased, was a $135 miss, $135 worse than the budget. But on the flip side of that, let's look at the actual usage per unit. We were more efficient than we budgeted, so we expected to use 225 meters to make those 90 units, but in reality only 180 meters of material were used to make those 90 units. So you can see there was a saving here. A saving in the amount of material that was actually used, and that offset by 90. So you can see here we've got a full breakdown of the variance analysis. We can present these insights to management and executive leadership in a company to make decisions about how we can improve operations going forward and learn from what happened over this last period. Now let's take a look at a simple example of fixed cost variance. We're going to pull up this information again, and we're going to see how the fixed cost may have been revised or not. In this case, they were not. And then the actual result that came in. So this is a little bit simpler. To calculate the fixed cost variance, we simply add up all of the fixed costs in the business and get the total, and we just compare that total to the total we had budgeted. And in this case, we see that there's a difference of 10, an unfavorable difference of 10. This can always move in either direction, so it's important to be clear of whether it's a favorable or unfavorable change. And finally, once the variable and fixed cost analysis is done, we can summarize it in a nice table where we see the impact, the volume, price, material inputs, usage, fixed costs, etc. And we get the total. So this is a great way of summarizing the impact of fixed costs, variable costs, volume, and price all in one little table.